Intro to the top 5 accounting ratios. Definition of accounting ratios. Accounting ratios are quantitative measures derived from a company's financial statements to evaluate various aspects of its financial health and performance. Importance of accounting ratios. Ratios provide insights into liquidity, profitability, and solvency, aiding in decision-making and performance evaluation. Now, let's meet the key ratios in financial health. Number 1, current ratio. Number 2, quick ratio or acid test ratio. Number 3, debt to equity ratio. Number 4, return on equity. Number 5, gross profit margin. The top 5 accounting ratios. Let's get to know them through their equations and personas. Number 1, current ratio. Number 1, current ratio, aka carry current financial lifeguard. Definition: measures a company's ability to pay short-term obligations. Equation: current ratio equals current assets divided by current liabilities. Personality: reliable and practical, always prepared to handle emergencies. With a keen eye on liquidity, she ensures there's always enough cash flow to cover immediate needs. She's the go-to person for managing short-term financial obligations. Number 1, current ratio example. Company ABC. Current assets, $200,000. Current liabilities, $100,000. Current ratio, $200,000 divided by $100,000 equals 2.0. Analysis. A current ratio of 2.0 means the company has twice as many current assets as current liabilities, indicating good short-term financial health. Number 2, quick ratio or acid test ratio. Number 2, quick ratio or acid test ratio, aka Quinn Quick Financial Detective. Definition: measures a company's ability to meet short-term obligations without relying on inventory. Equation: quick ratio equals current assets minus inventory divided by current liabilities. Personality: sharp and meticulous, focuses on essentials, ensures financial health without fluff. His no-nonsense approach keeps things efficient and transparent. Quick ratio, acid test ratio example. Company XYZ. Current assets, $200,000. Inventory, $50,000. Current liabilities, $100,000. Quick ratio, $200,000 minus $50,000 divided by $100,000 equals 1.5. Analysis: a quick ratio of 1.5 means the company has 1.5 times its current liabilities in liquid assets, indicating strong short-term financial health without relying on inventory. Number 3, debt to equity ratio. Number 3, debt to equity ratio, aka Dexter Debt Risk Assessor. Definition: indicates the relative proportion of shareholders' equity and debt used to finance a company's assets. Equation: debt to equity ratio equals total liabilities divided by shareholders' equity. Personality: analytical and cautious, balances risk and reward, ensures a stable financial foundation. His careful assessments help maintain a balanced and sustainable financial structure. Number 3, debt to equity ratio. Example: Company DF. Total liabilities, $300,000. Shareholders' equity, $600,000. Debt to equity ratio, $300,000 divided by $600,000 equals 0.5. Analysis: a debt to equity ratio of 0.5 means the company has half as much debt as equity, indicating a conservative approach to financing and lower financial risk. Number 4, return on equity, ROE. Number 4, return on equity, ROE, aka Rosita Return Profitability Guru. Definition: measures a company's profitability by revealing how much profit it generates with the money shareholders have invested. Equation: ROE equals net income divided by shareholders' equity. Personality: energetic and driven, focuses on maximizing returns, passionate about financial success. Her enthusiasm for growth keeps the company striving for higher profitability. Number 4. Return on equity, ROE example. Company GHI. Net income, $120,000. Shareholders' equity, $800,000. ROE, $120,000 divided by $800,000 equals 0.15 or 15%. Analysis. An ROE of 15% means the company generates a 15% return on shareholders' equity, indicating efficient use of investment funds to generate profit. Number 5. Gross profit margin. Number 5. Gross profit margin, aka Garrett Gross, Revenue Optimizer. Definition: shows the percentage of revenue that exceeds the cost of goods sold, or COGS. Equation: gross profit margin equals revenue minus COGS divided by revenue times 100. Personality: strategic and focused, ensures sales are profitable, manages costs effectively. His strategic thinking and attention to cost management help the company maintain strong profitability. Number 5. Gross profit margin example. Company JKL. Gross revenue, $500,000. COGS, $300,000. Gross profit margin, $500,000 minus $300,000. Divided by $500,000 times 100 equals 40%. Analysis. A gross profit margin of 40% means the company retains 40% of its revenue as gross profit, indicating effective cost management and profitability. Now let's recap the top 5 accounting ratios. Starting with Number 1, current ratio, which equals current assets divided by current liabilities, aka carry current. Number 2, quick ratio, acid test ratio, which equals current assets minus inventory divided by current liabilities, aka Quinn Quick. Number 3, debt to equity ratio, which equals total liabilities divided by shareholders' equity, aka Dexter debt. Number 4, return on equity, ROE, which equals net income divided by shareholders' equity, aka Rosita return. And last but not least, number 5, gross profit margin, which equals revenue minus COGS divided by revenue times 100, aka Garrett Gross. Understanding these ratios and their personas can help you better manage and assess financial health. Stay tuned for more financial insights.